Hello, greetings, and welcome to Dividend Blasters. This is our 28th video. Our topic today, invest like Warren Buffett. Oracle of Omaha, Berkshire-Hathaway's top holdings. You know, as dividend growth investors, we are looking to build financial independence. And on our path to financial independence, we want to establish passive income. We do this by buying dividend growth investments that are going to continually grow and grow their dividends and build our passive income for us. So, Warren Buffett is the king of financial independence. He's the king of passive income. The gentleman is going to be 93 years old. He's a force of nature. He's been an investor for more than 75 years. He's got a net worth of over 115 billion. His dividend income, I don't remember. I believe the last figure I heard was in the hundreds of millions of dollars annually. So what are we doing here? Basically, what I'm doing is I want to see what he does in his portfolio for Berkshire-Hathaway. So I pulled his 13F submission. That's a quarterly submission that institutional investors must submit the Securities and Exchange Commission. Okay, if you're an institutional investor and you're managing more than $100 million in assets, you have to submit a 13F. It shows all your holdings and for the last quarter. So that's what I'm going to share with you, and we're going to go through that. And I'm going to take a hard look at this. And some of these I've looked at. I said, yeah, that's great. And then some of these I would have questions on. I would say I probably wouldn't buy that. Now, obviously, we're not all Warren Buffett. He's got his reasons. He's got information that the rest of us don't have, but we can ask questions, and that's the benefit of this. So, quick disclaimer, I am not your financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions. So please do your own research, do your own due diligence, and consult a licensed financial advisor prior to making any major financial decisions. Now, I've been an investor for more than 30 years. However, before I make a major financial decision, I call my money manager, my financial advisor who I employ, and they manage my retirement accounts. But I call them up and I say, hey, what do you think of this? What do you think of that? And I get their opinion and I leverage their expertise. And that's the benefit of having them. You know what? They're the professionals. Leverage them. See what they say. Now, you know what? We don't always agree. And in the end, you know, I'm going to make the decision. It's my money for the money of mine that I manage. The money of mine that they manage. But the money of mine that I manage, I'm going to make that call because it is my money. And when you make a decision, it's going to be up to you. It's your money. All right, let's press on. I already talked about the 13F. It's required quarterly for institutional investment managers that have at least $100 million. So we're going to take a look at his and see what we got. Now, what you're going to see is I've got 3 slides here. They break up his holdings into 3 slides in order from largest to smallest. So there's 49 of them total. And the shaded fields to the right, kind of a light yellow, very light yellow, I pulled from Seeking Alpha. And what I'm sharing with you are the latest trading price, the PE ratio. I also pulled the PE ratio for the S&P 500 as of April 1st. I got the dividend yield. I got the CAGR for 5 years. So recall, the CAGR is the compounded annual growth rate, or it's the dividend growth rate. It's a historical metric for the last 5 years. And then I created something called the hurdle. Okay, so it's the sum of the dividend yield and the CAGR. Typically, I like to see something at 10% or more. And then also, we have the payout ratio. What is the ratio of dividends paid out versus earnings? We typically don't like to see anything more than 60%. You know, somewhere in the range of 20 to 60 is safe. It's a safety measure. And then the dividend growth streak. How many consecutive years have these companies been increasing their dividends? And then the sector and the industry. So what I did, I bolded and italicized the companies that I would buy, and many of these I already have. Um, the ones that I did not bold or italicize, I would pass, or I'd ask a question on. And some of them are great companies that I've had before, or maybe I just don't know enough about. But anyway, and then one other point, there's a couple here shaded in yellow, and there's a few others on other slides. Um, there has been some movement subsequent to his 13F submission in February. And he did a interview back in April. He basically said he was selling all of his banking stocks, or most of them. So he has sold most, if not all, of his Bank of America stock, which is amazing. That was his second largest holding. I did not read Citigroup, but I'm presuming when he said all of his banking stocks, he sold them. So that's why I shaded them yellow, because I don't think he owns these anymore. And there's a few others as we go through the list, you'll see. So let's go from top to bottom, and I'm going to go through fairly quickly. You all know about Apple, the computer company. A great company. I actually used to hold them for several years. I did sell them when it became abundantly clear that they were overly dependent on facilities that they had in the People's Republic of China. So I thought that that was a risk. Now, my understanding is that Tim Cook is looking to expand and have facilities in India. We'll see how that goes. But looking at the numbers, they're fine. I would say I would like to see a dividend yield a little higher. It's an anemic dividend of 0.54%. You know, if they were to get it up to 1.5% or 2%, they would actually clear the 10% hurdle. And of course, the payout ratio is low because the dividend yield is low. We already talked about Bank of America. Chevron, I've got that bolded. I say yes. I have several shares of Chevron. It's a wonderful company. I like that PE ratio, a little under 12. It's much less than the S&P 500's ratio of 22. You know what you'll see? That a lot of the oil and gas stocks, their PE ratios tend to be lower. So that is kind of symptomatic of firms in that sector. You know what? I like the yield of 3.58%. It's a decent CAGR, 5.76%. The hurdle rate, a little bit under 10. I would love to see it at 10 or more. If that CAGR was maybe 6% or 6.1%, I think that would be just wonderful. The payout ratio, it's great. 30%. It's a safe dividend. They are a dividend aristocrat. They've been doing it for 35 years. I say yes. Coca-Cola, I used to own Coke for several years. I actually sold them years ago because I did need the cash for an emergency, which you never really want to do that, but sometimes you have to do that. But today, I would probably say no to Coke. And Coke's a great company. You can see they're a dividend king, 60 years. I say that their first thing that I see is that their payout ratio is a little too high for my taste. It's almost 71%. The hurdle rate is only 6.35%. So I would, I'd be basically looking for a higher dividend return or a higher dividend CAGR. So I'd like to see maybe a CAGR of 6 or 7% to pull that hurdle rate up closer to 10. It's a great company, but when you have limited resources, you're looking as an investor to get the best allocation of your dollar so you can get the best return to build passive income that's growing your holdings, growing your passive income, and rocketing you to financial independence. So I would say no to Coca-Cola. Next one, American Express. Well, I have American Express. I like that hurdle rate of 11%. That stands out to me, and the PE ratio is good. It's 14.5. Now, they've only grown their dividend for 1 year, but I'll tell you a little backstory behind this. I own Visa, and we're going to get to that one. I've owned Visa for several years. I was looking for another payment technology. credit debit card stock. So I went with Amex. And Amex is a good company. They've been around for a very long time. They've been around since the 1880s. They're older than Visa. But anyway, they're a good company, so that's why I got them. Kraft Heinz, I'd say no, and I'll tell you what stands out immediately is the negative CAGR of minus 8.35%. That's pulling the hurdle rate down to minus 4.28%. And even with that dividend cut, and that's what that means when you see a negative CAGR, they cut their dividend. That payout ratio was close to 60%. So I would say no. I'm going to pass on Kraft Heinz. Great ketchup, but I would say as far as getting my dollar, the answer is no. Occidental Petroleum, same thing. There's a negative CAGR here, minus 28.59%. You got a negative hurdle. My question is, your payout ratio was so low, 5.57%. What happened? Why is the dividend yield so low? Why has the dividend been cut? That's my question. All right, next one. Moody's. Well, Moody's, I would probably say yes. Now, the PE ratio is high relative to the S&P 500. I mean, it's a $313 a share stock. One thing I would do is I would want to look closer at the PE ratios in their sector. Now, I think in that sector, they're probably all a little bit high or higher. I take a closer look at that. But right now, when I see the dividend yield, just an eyelash under 1%, and I see that 5-year CAGR of 12.68%, I think that's fantastic. You basically are clearing 13.6%, and they've been increasing their dividend for 13 straight years. The payout ratio is only 33%. That looks like a very safe growing dividend to me. Next one, Activision Blizzard, I would say no. And I actually have a handful of shares of Activision Blizzard. First thing I see is they don't pay a dividend. So, to me, that's kind of a non-starter unless you're looking for a technology stock or an entertainment stock that you feel is going to offer extraordinary price appreciation. Okay, so for instance, like a Google or an Amazon that don't pay a dividend and have done that, or Tesla has done that. If you're looking for that, then you can take a closer look. But let me say this, they have a decent PE ratio. It's a little bit under 20, but more importantly, they are the target of an acquisition, a friendly acquisition by Microsoft. Microsoft wants to incorporate them into their gaming business. And you all know about Microsoft's Xbox. It's very popular. This could actually put them in a much more dominant position with Activision Blizzard. So if you're looking to buy it and maybe get a quick price appreciation through the acquisition, I'd say go for it. But anyway, that's my opinion on that. HP, formerly Hewlett-Packard, I say yes. Look at that PE ratio, a little bit under 9. And I love the yield. The yield is great, 3.5%. The CAGR, 13.5% is fantastic. That'll put you over 17%. The payout ratio, 27. So that is a very safe dividend, and they've been growing it for 12 consecutive years. So I say yes. I'm going to go through the rest of these fairly quickly. DaVita Healthcare, that's more of a kidney dialysis type company that does equipment and facilities. I would say no. I got healthcare stocks. They do not pay a dividend. VeriSign, that is a technology company, and you've probably heard of them. On email or on your laptop, you see them offering service to your company. They offer it to ours, but they don't pay a dividend. So I would say no. Citigroup, that's a bank. I would say no. Kroger, absolutely. Kroger is a big grocery store chain, and I believe they're headquartered in Cincinnati. I like that PE ratio. It's a little under 11. It's got a okay dividend yield, but really stands out is the CAGR, almost 15%. That'll put you at 17% hurdle, and it's safe. 23% payout ratio, and they've been doing it for 16 consecutive years. Yes to Kroger. Visa, yes, yes, and more yes. I like Visa. PE ratio is, well, it's a little bit higher than the S&P 500, but look at that dividend yield. Okay, it's modest. It's less than 1%, but the CAGR 17.5%, outstanding. It's going to get you to 18.3%, and they've been doing this for 14 years. I actually, if you go back and look at a video I did on scenario analysis, when you invest in companies like Visa and Microsoft, if you invest in Visa, let's say you put $5,000 to start and you are putting $500 a month, and you do that for 20 years, 30 years, you are going to make a lot of money because you're going to continuously grow your holdings based on price performance. And when I did my analysis, I looked at history, okay? But also I looked at the dividend yield that I started with, and then I also looked at the CAGR. It'll grow quickly. You're going to get a big snowball. They tend to start slow. And maybe the first 10 years it's slow, and then it starts to pick up. And when you get to like 15 years, it's huge. So I would say yes to Visa. Liberty Media, no dividend. I say no. And folks, just so you know, when I say no, when I do it quickly, I'm not saying anything bad about the company. The companies are fine. Warren Buffett has information that I don't have, but I'm just using my rules of thumb and my assessment on what I would invest my dollars in. I don't have 115 billion, so I got a tighter budget. GM, I would say no. I am not hot for GM, and I don't like that negative CAGR. So no. Paramount Global, this is interesting. It's not something I had looked at before, but take a look at that hurdle rate. It's 10%. So you got a 4.11% yield, a 5.92% CAGR. You're over 10%. And the payout ratio, 56%. It is a safe dividend. Now, guess what? Dividend growth streak, 0. They're just getting started offering dividends. I would probably say yes, but I might say yes. I'm going to watch and wait and maybe give it a year. But I would say yes. MasterCard, I like MasterCard. However, I already have a Visa, and Visa's cheaper. But what's interesting is that their yield and their CAGR are very similar to Visa's. So to me, the winner is Visa because Visa's cheaper. And there are actually more Visa customers out there than MasterCard customers. So there's more cash coming in. Aon, the insurance company, I have said no. It's close. Okay, they got a yield of 0.76%, a CAGR 9.17%. So they're at 9.93%. They're very close. They can afford to raise their dividend, in my judgment, with that payout ratio of 16.3%. If they get above 10% hurdle, I'll take another look at them. But right now, it's no. Charter Communications, I'm going to say no dividend. Bank of New York, I believe that Mr. Buffett divested his holdings in Bank of New York. So, normally I would take a close look at it. Okay, they got a decent dividend yield and a decent CAGR. But right now, I want to wait and see how things settle out or shake out in the banking sector. Next one, McKesson. Okay, it's a drug company, healthcare distributors. I say yes to McKesson. That price looks high, 364. The PE ratio is only 14, so their earnings are very high. The dividend yield is very modest, 0.59%. But look at that CAGR. It's almost 10% by itself. You're going to get to 10.5% hurdle. You know what? I would actually, if I could talk to somebody at McKesson, I'd say, why don't you raise your dividend just a little bit? Do you have to plow all those profits into R&D? Can you afford a little bit more? You get the payout ratio up, but you know what? Apparently they don't need to. It's good enough. Celanese, it's a chemicals company. I say yes. I like the PE ratio. It's under 9. You know what? I like the CAGR, 7.68%. The hurdle 10.3%, and it's a low payout ratio of 17%. So I say yes. Amazon, I used to own shares of Amazon, and I would say no. No, look at that PE ratio. It's huge. It's 70, and they don't pay a dividend. I actually held them for a few years, and I got a good price appreciation, and I sold it. And reinvested in other stocks that pay dividends. Snowflake, that's an IT company. I don't know enough about them. I know that they do work with data centers and cloud computing. So presumably they got a lot of high research and development type costs because they're a technology company. So they don't pay a dividend. So I would say no. Liberty Sirius XM series, so it's the satellite radio company. I actually am a customer. For stock, I would say no. Globe Life. That's an insurance company. I would say no. The dividend yield is too small for me. I'd like to see something a little bigger. It's a nice CAGR, but I would like for them to at least get one or the other up a little to get that hurdle rate above 10%. The payout ratio was very low. So T-Mobile, I'd say no. They do not pay a dividend of any sort. So the next one, Ally Financial. I would say yes to Ally. I am actually a customer of Ally. They are a great digital bank, if you will. I like that PE ratio of 7.48. And you know what? It's a great yield. Look at that CAGR. Now that is something. 19%. Wow. And so that's going to get them to 23.69%. They got a low payout ratio, so they can manage this dividend strategy of theirs easily. The payout ratio is 25%, and they've been doing it for 6 consecutive years. So Ally, I say yes. Markel Corporation, that is a casualty and property insurance company. I would say no. It's a little bit pricey for my taste. They don't pay a dividend. Restoration Hardware, ticker symbol RH. You know what? I'm a customer. I like their product. They do great work. But I would say no. There is no dividend in it for me. Taiwan Semiconductor. So this was another divestment that Warren Buffett did. Taiwan Semiconductor is a great company. They're probably the leading or one of the leading semiconductor companies on the planet. And they have a good yield and a great CAGR. But Warren Buffett divested due to geopolitical reasons because of China. And there is that threat of the People's Republic of China going into Taiwan and taking them over. So if they do that, you can bet that Taiwan Semiconductor would be controlled by the People's Republic of China. So something to think about. We have another Liberty Media, and I would say, again, no, 0%. This is just another class of shares of stock. Okay. And this is the last slide, okay, of the holdings. New holdings, this is a banking stock, no dividend, I say no. Louisiana Pacific Corp. Now, I like this. This is a company that deals in wood, lumber, and home building supplies and building them. I actually did a video on these guys several weeks ago because they had a wonderful dividend increase. Go back and check out that video. Their name is right in the title of my video. Louisiana Pacific, I really, really like this CAGR. When I look at this, I thought, wait a minute, what gives? Well, maybe that's a one-year thing. Well, no, they've been increasing their dividend for 4 consecutive years. So the dividend yield is modest, 1.61%. The CAGR, 47%. Goodness gracious, getting them up above 48% hurdle. Okay, the payout ratio is low, 7.69%. So what they're doing is they're compensating for the low yield with a very high CAGR, and they're carrying it out, successfully. I would say yes. Floor and Decor Holdings, no dividend. U.S. Bancorp, I normally would take a close look at them because I love the PE ratio. I love that dividend yield of 5.6% and the CAGR of 10%, but it's a bank, and I would be a little bit weary about that. And so I take a closer look at them. I might hold off. My understanding is Warren Buffett divested his holdings in U.S. Bank. So anyway, I'd pass on that. Stoneco Limited, I'd say no. There's no dividend. Johnson & Johnson. Oh, I love Johnson & Johnson. A dividend king. They've been doing it for 60 consecutive years. I like that PE ratio of 15. The yield at 2.91% is nice. The CAGR is 6.11%. I would like to see one of those a little bit higher. It's getting them at 9%. They're not quite at 10. The payout ratio is 44%. I've held Johnson & Johnson for several years. I think it's a good, reliable dividend payment. I'm holding on to it. And I would probably buy it today. I think it's still a good buy, even though, and I'd say that's probably one of the exceptions to the my own hurdle rule that I use. And other people use that as well. It's not mine. It's just something that I've acquired. Anyway, Marsh and McLennan. I would say, I don't have them bolded here, but I think that for me, I would probably say yes. Marsh and McLennan, yes, they have a hurdle rate of 10.8%, and it's really because of the CAGR, okay? The dividend yield is modest, and, the payout ratio is safe. So they have been doing it for 2 years, and, maybe for some of these, I might even wait and say, well, yes, but I'm going to wait. I'll wait until next year. So that's probably what I would do. Procter & Gamble, I like Procter & Gamble. I probably wouldn't buy them because I've got Johnson & Johnson, and again, it's a limited resources. I kind of see them as being very similar companies. They've both been around about the same time. They have similar presences out in the market. They're not identical, but I would say, you know what, I'd be fine buying them. Their payout ratio is a little bit more than 60%. The hurdle rate is a little bit under 10. So that's probably what's keeping me from buying them. And I got J&J. That's fine for me. Next one, Liberty Latin America. I'm going to say no. There is no dividend. Mondelez. Mondelez, the packaged food company. I say yes. Take a look at the PE ratio is a little bit above the S&P 500s. The dividend yield, it's 2%, but that CAGR is beautiful. It's 12.1%. It's putting them above 14%. The payout ratio, in my judgment, it's good. It's a safe dividend bet. It's less than 60, and they've been doing it for 9 consecutive years. So I say yes. Warren Buffett has a couple of ETFs. He's got SPY and VOO. I'm familiar with both of them. I actually don't have either of them. I am an SCHD investor, but I am looking for an S&P 500. And VOO is definitely one that I look closely at, and I'm thinking about it. Jefferies Financial. Well, this is more of an investment bank, but it is a bank. So I have it bolded solely because of the metrics and the price. The price is nice. It's $32. It's got a PE ratio of 14.5. I like the yield. I love the CAGR, and they are above 36%. Well, 35% in the hurdle rate. The payout ratio, it looks safe, 51%, and they've been doing it for 6 years. I would probably hold off for a year and just see how things shake out with the banks. That's just me. Anyway, next one, Liberty Latin America Limited. I'm going to say no. I don't know much about them, but they do not pay a dividend. So I'm going to say no. Last one, UPS. Now, who hasn't seen those little brown trucks driving around? They're everywhere. I recently did a comparative analysis between UPS and FedEx, and I've held UPS for a while, and I still hold it. I like UPS. They're about 3 times the size, market cap of FedEx, and they have a better dividend. So I say yes. I like the PE ratio. It's less than 17. It's got a healthy dividend yield of 3.6%, but I love that 5-year CAGR, 12.69%. They got a history of increasing their dividends. The hurdle rate, 16.29%. It's safe. You got a payout ratio of 51%. They've been doing it for 13 consecutive years. So I say yes, yes, yes to UPS. And folks, that's all I have. Thank you for taking this journey with me. I would kindly ask if you give us a like and subscribe to our channel and share it with a friend or a family member. Till our next video, have a wonderful day and God bless.